Hello, this is Adam Khoo here once again, and we had a really massive development in the markets yesterday, which is the S&P 500 has finally broken out of its consolidation pattern for over the last 4 months. Let's take a look. So you can see that S&P made a high back in July, and it could not break that high, right? In September, it made, again, that same high, so there was a very strong level of resistance over there. And at that time, a lot of people were saying, hey, you know what, that's not a good sign, it's bearish, right? Because, it's making a lower high. Some people are saying, hey, I've got this head and shoulders pattern, which I don't believe in all that crap, okay? And people are really bearish, right? But what has happened is that instead, the market has gone up and we have now broken above that level of resistance. Let's take a close look. Let's zoom into the charts over here. There we are, right? So that's your level of resistance, 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 right? Strong resistance. And as of yesterday, on the 28th of October, you can see that we had a breakout candle above that level of resistance. So what does this mean? Well, in technical analysis, when a price is able to break above a strong level of resistance, that's a bullish sign. So probability is that the market has still a lot of room to run from on the upward in the upward direction, right? There we are. Okay, so we've got 2 months left to 2019. Now it's coming to the end of October 2019. We've got 2 months left. So based on the price action, it looks like we have a lot more room to run up to the end of the year. Now again, anything happens, so we can't predict the future, but this is based on the current trend of the market. Okay, so what's really important is that the market has to stay above this level. Sometimes breakouts could be false breakouts. Sometimes it could break out, come back down again. You never know, right? So if you really want to be cautious before you take a lot of additional long positions, you want to wait for it to kind of like retrace slightly and find support at the previous resistance, right? So this is resistance, 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 breaks out, comes back, finds support, and when it's able to stay above this previous resistance. Remember, in technicals, previous resistance becomes new support, right? So if it comes back down again and can hold above this level of support and remain above that level for the next few days, that's a confirmation of a very, very bullish market. That's when you can really add a lot more long positions, right? So if you watch my previous videos, I've talked about this pattern, right? So if you have got market going up, making a high, another high, another high, so that's what we call a resistance level. So this means that there are a lot of sellers over there waiting to sell. So the moment the price goes up, the sellers come in and sell, 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 supply exceeds demand, and the price comes back down again. So that's what causes the market or a stock to be trapped in a level of consolidation. But if there are enough buyers, what happens? Eventually, the price would break above this resistance level because, now demand has exceeded supply. All the sellers here have been taken out by the buyers. There's no more sellers left. There are buyers now, no more sellers left at that level. They've been taken out. And usually what happens is after a breakout, we expect it to continue going up. But again, it could be sometimes a false breakout. You never know, right? So to be safe, like I said, after a breakout, if you can have some kind of a slight retracement back so that this resistance becomes support and it's able to stay above the support, boom, it goes up, and then we can really add a lot more long positions over there. So right now it's a bit premature, but for now it looks like a pretty bullish sign that the market's headed upwards at least in the next couple of months. So market's really bullish right now, all-time high in the markets, fantastic, right? By the way, the S&P right now is up about 20% year to date. My portfolio is up about close to 37%, so I'm pretty happy beating the S&P every year. And China is up about 30% for the year. So markets have been really bullish for this year, and most of, if not all, my students are making a lot of money in the markets, not just me. But don't forget that just 2 months ago, the mainstream media was very bearish about the markets. If you read the mainstream news, everyone was saying in the mainstream that it's a recession coming, gonna sell stocks, gonna short the market, right? And again, like most retail investors, when you read all these predictions and opinions from the mainstream media, you always get screwed, right? right? Back in 2 months ago, people were saying sell, and a lot of people would have sold over there, right? Fearing a crash, they sold over there, came down, they sold over there, and now the market's up here. They've missed this opportunity to be in the market for this rally. In fact, let's take a look at some of the news that was in the media in the last 2 months. Let's check it out, right? I've saved some of these clippings. Let's take a look at this. All right, now this was back in August, right? The 5th of August, and this was from Investors Business Daily. It said bears send stock market spinning lower as recession fears rise. So almost every single day, headline was recession. And this was August 22nd. Recession may already be here. Long-time market bear David Tice warns. So this guy's a bear. He said recession's already here. Don't be in the market, get out of the market, right? So a lot of people started selling in August because of all this news. And then in October, the 1st of October, this was on CNBC, right? Low profit growth threatens rising debt and possible recession, S&P warns. So this is from S&P itself. S&P is telling you that, hey, possible recession, low growth, be careful, all right? And October the 7th, Gary Schilling, who's an economist, he said, time to start shorting the S&P 500. You know, this guy's telling you to short the S&P. Should you listen to this guy? Well, I don't. You know, to me, I never listen to economists when it comes to investment advice, right? Have you ever seen a rich economist? I haven't. Have you seen a rich academic? I haven't. So, and this was on the 8th of October. The father of the yield curve indicator says now is the time to prepare for a recession because of the inversion of the yield curve that happened a month or so ago, which I talked about in my earlier videos. And I said that, hey, you know what? You can't rely on the yield curve to get off the markets. It's really, really not a good leading indicator. Instead, you have to look at the price action of the markets. But you know what? This is the father, right? Who shouldn't listen to the father? Okay. And on the 16th of October, this was just about 2 weeks ago, awfully high risk of a global recession in the next 12 to 18 months, Moody's chief economist says. Again, don't listen to a guy from Moody, right? Because he's moody, you know, he's upset. Why do they call it Moody's? They should call it happy, right? Of course, it's from Moody's, it's going to be moody all the time. So again, people who listen to all this news, what happens, right? They would have panicked and said, oh my God, it's a recession, and they would have sold over here, panic, recession, sold over here, and now the market's over here, and they would have missed out. And you know what's the crazy thing? Now that the market has broken out, the mainstream media is singing a different song. Just yesterday, this was the new article that came out. Yesterday, right? 28 October, yesterday. Chart analysts say new record gives investors the green light to jump back into the bull market. Yeah, now you tell me, after I got out, you asshole. Okay, in other words, if you read the mainstream news, it was sold here, got out, now it's here, you asking me to buy back? Are you nuts? You know, so never listen to the mainstream news to make investment decisions, right? The way to make money in the markets, I've said many times in my past videos, is look at the fundamentals of the market. Look at the fundamentals of the companies. And I said in my previous reports that many companies right now are still undervalued. They are fairly valued, right? And they are worth buying. At the same time, looking at technicals, you can see the market has always been on a clear uptrend, okay? With this 150 moving average acting as a very strong level of support. Every time it hits the 150, it bounces off, it bounces off, it bounces off. And sure, it was not making higher highs, but we were in a clear uptrend with the 50 moving average above the 150 and the price above the 200 moving averages. As long as you got the 50, the 150, the 200 sloping up, that's a pretty clear sign the bull market is still intact. So again, if you have watched my previous videos, and again, I release a video on YouTube at least once or twice a month, I would have mentioned about the fact that we should have stayed bullish on the markets and not have gotten out of the markets. My students, they all get my monthly reports on the first of the month. And again, these reports are worth, you know, millions of dollars with the knowledge, right? But my students get it for free. And that's the great thing about being in my community. And Let me just show you my one of my reports. This was in October. That's right. This was my October report. All right. And this was, again, the 1st of October, the beginning of the month. This was about 4 weeks ago. And I said that, let me just read to you what I said. All right. Again, the sad thing is that the majority of retail investors out there who have not been trained in our skills and knowledge would probably have missed the gains yet again. Why? Simply because they are constantly spooked about recent negative news headlines in the mass media about the coming global recession, yield curve inversion, trade war getting worse, Hong Kong riots, Brexit chaos, US to restrict investments into China. All the bad news causes people to sell. Remember, we should never listen to the advice of mainstream news headlines. They are market noise and distractions that only serve to make you emotional and make you buy and sell at the worst possible time. As savvy investors and traders, our decisions are always based on company fundamentals, looking at the intrinsic value of the companies. Like I mentioned, most companies right now are undervalued. Google's undervalued. Amazon's undervalued, right? Great companies are really undervalued. In fact, Amazon is right now still selling at about $1,700 per share. To me, the intrinsic value is over $2,000 to $2,400 per share. So it's massively undervalued, Amazon. It's not gone up yet, but I'm holding and I'm adding shares regularly, right? And at the same time, you must also look at the technical analysis of the markets following the trend. So I mentioned in my report, I said, there are a few reasons why I'm still really bullish on the market. So when everyone was selling, I was buying, I was holding, and I said a few reasons. Number one, the technical uptrend remains intact, right? The markets above the moving averages, they're sloping out, is intact. Many sectors like big tech, healthcare, cyclicals, and banks remain really undervalued. And that's why I was buying up banks like Bank of America, JP Morgan 2 months ago when they were really undervalued. But now the price has gone up. Now they're a bit expensive right now, right? So I may be taking profits on some of the banks. As well as I mentioned, the yield on the S&P 500 has crossed above treasury bond yields, indicating that stocks are very undervalued relative to bonds, which are overvalued, right? So, and I said historically, markets rally 15 to 25% following a yield curve inversion. So the yield curve inverted about a month and a half ago, and that's why I said the market will likely go up another 20%. So those are all the reasons I was bullish on the market, and as you can see, it pays to follow your own rules, right? Because you stay in the markets, and year to date, let me just check my year to date performance. It's one of my portfolios. Yeah. So the green line is my portfolio, and the blue line is the S&P 500, right? So always compare my performance to the S&P. So as of now, year to date, I'm up about 37%, my portfolio, compared to the S&P, which is about 19%, right? So again, my goal annually is to always beat the S&P 500 as much as possible to double the S&P. Over here, you can see a look at some of the holdings in this portfolio over here, right? So I've got Amazon, I've got Boeing, I've got Alibaba, Bank of America, Domino's Pizza, you've got Facebook, you've got China ETF, GXC, Johnson & Johnson, JP Morgan, and these are all the companies that I mentioned in my monthly reports. So in my monthly reports, I break down what I'm buying, why I'm buying it, what I'm selling, why I'm selling, and stocks I'm looking to buy in the coming month, right? You've got 3M, you've got Microsoft, you've got Nike, you've got the S&P ETF, you've got Tencent. So these are some of the companies which I'm holding right now in the portfolio. Now, a lot of people have been asking me, Adam, do you think the market's currently a bit overbought? In other words, has it gone up too fast, too far, and it's really to pull back? Well, here are my thoughts on it, right? And let me just share with you now how I measure overbought and oversold conditions in the market. So for those of you who don't understand this concept, let me just kind of like explain. Now, remember that the market, even on an uptrend, doesn't go up in a straight line, okay? Because what happens that when a market goes up, after a while, it becomes overbought. It's kind of like a rubber band, right? When you pull a rubber band too fast up, what happens? It gets overbought, and it'll tend to snap back down, right? So it gets overbought at some level, and it will come back down again, okay? But once it goes down too fast, it gets oversold. Again, rubber band pull. If you pull the rubber band down too fast, it's oversold, it'll snap back up again. and then snap down, snap up, snap down, so on and so forth, right? And again, I like to compare it to like a breathing pattern, right? So you breathe out, you can't breathe out forever, right? After a while, you run out of breath, right? And it's overbought. So you got to breathe in again. So you got to breathe in again. And then when you breathe in enough, you can't hold anymore. You get oversold, and then boom, it goes up again, right? So as an investor and as a trader, it's really important to know when the market is kind of like oversold. That means it's come down far enough that it's ready to bounce back up again. Again, this is what we call oversold. Oversold. And at the same time, it's also important to know when the market's overbought. When it's like, it's gone up too fast, it's overbought. And it's going to, there we go. It's overbought and it's going to pull back down again. There we go. So as you can imagine, as an investor, when do I like to buy? I like to buy when the market's oversold. When the price has gone down too fast, it's oversold, I buy over here. I buy over here and I buy over here. That's right. And once the market becomes overbought, I could take some profits, or I could sell call options, covered calls, or I buy put options. So when it comes back down again, I'm making some money as it's coming down. With the extra profits, I can buy more once it's oversold to catch the next wave up. And that's what great investors and great traders do. So if you look at it in the context of the S&P, so this is what we call it's over, that's right, overbought, right? And then boom, comes down, oversold, boom, goes up, overbought, comes down, oversold, goes up, overbought, comes down, right? So these are oversold levels and these are overbought levels. So question is right now over here, where we are over here, are we overbought yet? Right? Have we breathed out till we've got no more air and we're going to breathe in again, right? So how do I tell overbought and oversold levels, right? So one of the things that I do is I use oscillators. Oscillators help me to identify whether the rubber band has gone too much in one direction, right? So there are two oscillators I use. Well, one is not really an oscillator, but I use it as an oscillator, right? So I use the stochastics oscillator and the Bollinger Bands, and I use them both together, right? So this is how they look like. In fact, under my studies, I've got this thing called overbought and oversold levels, right? So I put it in there, boom, there we go. So the black lines, these are the Bollinger Bands, and over here I've got the stochastics level. So how do I use these indicators? Here's a quick lesson, right? So first, let's look at the stochastics. Now again, stochastics help me to measure oversold and overbought levels. And how is that measured? Well, let me just kind of like zoom in a bit so you can take a closer one. Let me make this a bit bigger so it's a bit clearer for you guys. All right. So over here, this green line is the 80 level, 80, and this level is called the 20 level. There we go, right? So simply, whenever we have got, now these two lines are called the percentage K and percentage D lines. So whenever one of these lines or both the lines, they go above 80, right? So that I can see this above 80, that means it's overbought. That means the rubber band is, stretched too high, is likely to, the market's likely to come back down again. And when the stochastics is below 20, it is oversold. So whenever, these two lines go below 20, likely the market's going to snap back up. When the two lines go above 80, likely the market's going to snap back down again. So that's how we use it. It's like kind of like a pendulum, right? So over here, you'll swing back to there and back to there again. Now, the way I use it is really simple, right? So for me to identify an overbought level, I must have one or two of the lines above 80. They must be above 80 and they must come back down below 80. So once they go back down, I'm looking to protect my portfolio or to do a short on the market as the market comes back down again. Similarly, when the two lines or one line is below 20 and it gets back, once it crosses back above 20, that's an indication market is going to go up again. That's when I start buying aggressively. Okay, so that's how we use the stochastics, right? Now, how about Bollinger Bands? So Bollinger Bands, you can see over here, they are kind of like boundaries, right? Yeah, they're kind of like boundaries over here. So the moment the price hits the lower band, right, it's oversold, you'll tend to bounce back up again. When it hits the upper band, right, it's overbought, it bounces down again. Now, a lot of people, they use Bollinger Bands or stochastics in isolation. You can't do that. I find that to be really accurate, you have to use them both together, okay? So for me, I only identify an overbought or oversold level when at least I have got 2 out of 3 conditions that are met. Number 1, Bollinger Bands. Number 2, stochastics. And number 3, I must see some kind of moving average, support or resistance level. So once I've got 2 out of 3 conditions, I know that market is going to reverse in the opposite direction. All right, let's take a look at some recent examples of how I use this to read the market, right? So over here, you can see that this again is the S&P. You can see the price hit the lower Bollinger Bands. So which means it's oversold on the Bollinger Bands. But the stochastics, you can see, is not below 20 yet, which means it's not oversold because I need both of them to show me an oversold condition before I'm convinced, right? So this was not, a buy entry basically, right? Now then over here, you can see it hit the lower Bollinger Bands again, went below the lower Bollinger Bands, and this time the stochastics went below 20. So I've got 2 conditions that are being met right now. Now, not only that, but it is also bouncing off one of the moving averages, which is the 150 moving average. So I've got 3 conditions. Lower Bollinger Bands being hit, stochastics below 20, and moving average being hit. 3 out of 3 conditions is really, really powerful. That's when I know it's time to buy, okay? There we go. So the moment the price or the indicator goes back above 20 over there, it goes back above 20, that's when I buy. So I would buy over here to catch the next wave up. There we go. Simple enough, right? Now, how do I know it's going to come back down again? Again, I'm watching for it to cross above the upper Bollinger Bands. There we go. You can see, let me just zoom in. There we go. It crossed above the upper Bollinger Bands. That's 1 condition. I need 2 conditions. I've got stochastics above 80. There we are. I've got 2 conditions being met, which means I can now short the market, sell covered calls, buy put options to protect my portfolio. So the moment it goes back down below 80, exactly at that point, I would short the market and make some nice profits as it went down. There we go, right? So how do I know it's gone down enough? It's going to bounce back up again. Again, what do? That's right, look at the lower Bollinger Bands. So again, here, you can see it crossed the lower Bollinger Bands over here, right? And stochastics below 20 over here. So I've got 2 conditions being met again. And it's also bouncing off the 150 moving average. 3 conditions, bouncing off moving average, low Bollinger Bands being hit, stochastics below 20, it's a clear buy signal. So the moment it goes back above 20, that's when I would buy again, right? So I bought here, and it went up a bit, came down a bit, went up a bit, came down, and went all the way up, okay? Now, over here, it came down, and at this point, how would you know it's going to come down? So let's take a look. Now, over here, you can see what has happened, right? The price went up. Now, it did not hit the upper Bollinger Bands. It did not hit the upper Bollinger Bands, but the stochastics went above 80. So I've got 1 condition. Remember, I need 2 out of 3 conditions. So I don't have the Bollinger Band condition. I have the stochastics condition, but I have got a resistance condition. What does it mean? See a resistance over here, test 1, test 2, test 3, test 4. So this is what we call a strong resistance. So I've got 2 out of 3 conditions again. Resistance being hit and stochastics above 80. So that would have been a short as well to catch the market going down again. So it's very reliable, 2 out of 3 conditions. And over here, it came back down again, all right? Again, hit the lower Bollinger Bands, that's 1 condition. Stochastics went below 20, that's 2 conditions. And 3 conditions is hitting the, again, 150 moving average. 3 conditions over there. Clear buy signal. The moment the stochastics goes above 20, we buy again, we buy, we ride the market up. There we go. So that's how I use all these things to tell reversals in the price on an uptrend. So question is, right now, are we at a reversal point? The answer is not yet. Why? Because, okay, you can see the stochastics, we are above 80. We are above 80, so that's one condition. But we have not hit the upper Bollinger Bands yet, so I don't have the second condition yet. And I'm not hitting any kind of resistance level, so there's no third condition. So right now, I've only got one condition, which means that likelihood is we're not coming down yet. So I'm still bullish, but once it hits the upper Bollinger Bands, or there's a resistance, by the way, there's no resistance anyway, because we had all-time high, right? So the moment we hit the upper Bollinger Bands and this starts turning down, I could take some profits of some of my positions, buy some put options, sell some covered calls, so when the market comes down, I'm making some good money, and once it comes back all the way to wherever it is, I could buy back for the next leg up. All right, so that's how I manage my portfolio using both fundamental and technical analysis. I hope you've learned something from this video. If you have, subscribe, watch all my videos in the past, present, and in the future. And remember guys, do check out my Facebook channel as well, where I post my latest updates about what's happening in my life and the markets. So this is my Facebook page. It's my handle is Adam Khoo Success. When you go to the page, you should see this picture over here. Now I have to tell you that because there are a lot of impersonators out there creating fake Facebook, Instagram pages impersonating me. So you gotta know what's my official, Facebook and Instagram channels. Really important, right? So again, on my Facebook page, you will see my latest updates, personal updates as well. By the way, this was a very proud moment of mine. I just celebrated my wife's birthday a couple of days ago. We've been together now for 25 years, right? She's one of the best investment I've made all my life, right? She's a person with great fundamentals, great technicals, and I met her when she was very undervalued 25 years ago, right? Now, the other thing which I also mentioned recently that I want to draw your attention to is be careful. There have been a lot of scammers creating fake clubs using my name illegally. So they call this Adam Khoo Trading Club. It's a Telegram chat group. It's 450 subscribers, and they may think it's me. It's not me. This is all fake. All right, and you can see I took some screenshots of this portfolio. Now we've informed Telegram. I've made a police report, so hopefully Telegram is going to shut them down. But you can see that by following these scammers, they are making huge losses. Some people lost all their money because they get scammed by these impersonators, right? And now they're saying, we are very sorry for your losses, guys. Yeah, right, bastards, right? So remember, please do not be scammed. Only go to my official channels, my official website, which is piranhaprofits.com or wealthacademyglobal.com. And these are my official Telegram group channels. This is my Forex private community chat group. This is my options private chat group. This is my investing chat group. So these are all my official groups. And the only way to get into my official Telegram private community where you invest and trade with me together every single day is you have to enroll into my courses, either my live courses, Wealth Academy, the live course in Singapore, or my online courses at Piranha Profits. Please do not be scammed by impersonators who promise you, free chat groups and free alerts. They are all scams, right? So please be careful. With that, I hope it's been useful, and I look forward to seeing you in the next video. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.